Namaskar. After understanding the basic concept of the accountancy, we need to understand certain basic terms used in the accountancy. Because every profession is having some specific terminology, and that terminologies are having some specific meaning. Unless until we understand that specific terminology, it is difficult to proceed further. Number second, these basic terminologies are very much regularly coming in the examination in the form of matching, also in the form of fill in the blanks, also in several forms these are coming in. So from in the examination point of view also, understanding the basic terms of accountancy is very much important. So let us understand one by one some basic terminologies. So first is entity. Entity means business entity, we say na. So entity means a reality that has its individual existence. The moment we say some entity, that means it is having some definite individual existence. Business entity means a specifically identifiable business enterprise. That enterprise is known by its numbers, names, DMart, Big Bazaar, Supermart, Reliance. So these are the business entities, they are known by their names. An accounting system is always devised for a specific business entity. Number second, transaction. An event involving some value. Some value has to be there. So an event involving some value between two or more entities. That means one is selling, one is buying, one is giving, one is taking. So it can be a purchase of goods also, receipt of money also, payment to a creditor also, incurring expenses also. It can be a cash transaction or credit transaction also. Asset, very important terminology, please note it down, it generally comes into the examination. Assets are economic resources of an enterprise that can be usefully expressed in monetary terms. So generally enterprises are having some resources, economic resources. For example, they will be having some land, they will be having some buildings, they will be having some machineries, they will be having some trucks, they will be having some vehicles. These all things are required for the purpose of business. So these all are of permanent nature, these are known as asset. So asset are the items of value used by the business in operation. For example, supervisor owns fleet of trucks, so it's asset. These are the various varieties of the assets. Then comes to liability. Liability are obligation or debts that an enterprise has to pay at some time in the future. Liability means some obligation or some debt of the other party. Some other party has paid something, or some other party has given some services or goods on the credit. So today or tomorrow they have to be paid. So that is whether today paying or tomorrow paying. That comes under the transaction. So they represent creditors' claim. It is called the liability. Whether it is paid today or to be paid tomorrow, that is known as liability. So they represent creditors' claim on the firm's assets. Both small and big businesses find it necessary to borrow money at one time or other. The business enterprises are like that only. Today or tomorrow they need some money for expansion also, for several purposes. So when they take the money, the liability arises. When they take some raw material, the liability arises. So some forms of liability is also here. Then comes to capital. Amount invested by owner in the firm is known as capital. Whatever amount has been invested by the owner, That amount is known as capital in the accounting terminology. It may be brought in the form of cash or asset by the owner for the business entity. Capital is in the obligation and a claim on the asset of the business. Now sales. Sales are the total revenue from goods or services sold or provided. Generally, some entity will provide services, some entity will sell the goods. So whether selling the goods or providing the services, whatever amount is coming, that is called sale. Sale may be in cash sale or credit sale. Business area, some transactions are cash, but many transactions are in credit. Then revenue. These are the amount of business earned by selling the product or providing the services to the customers. These are the called sales revenue. This is the revenue. Revenue means your earning. Revenue means your income. Income of the business entity. Earning of the business entity. So how it will have income? Only two ways. Either by selling the products for what it is made, or providing the services or what he is there. So by providing the services or by selling the goods, revenue is generated, that income comes. There are some other ways of revenue generation also. Main revenue generation is by selling a product or providing services, but there are some ancillaries revenues sources also. They are commission. Sometimes they get the commission also, they get the interest also on the amount deposited, they get the dividend also from the companies, they get some royalty also, they get some rent also. Like this, these all are called the revenue. So revenue is income. Expenses. Costs incurred by a business in process of earning revenue are called expenses. So whatever revenue is generated by some expenses incurred in the process, and that only revenue comes. First you have to spend. So whatever whatever costs incurred in the by the business in the process of earning the revenue are called expenses. Generally, expenses are measured by the cost of assets consumed or services used. So the usual items of expenses are, some of the expenses are depreciation, rent, wages, salary, interest, cost of heater, light, water, telephone. These all are recorded in expenses head. Now there is one another terminology called expenditure. Yes, expenditure is different from expenses. Spending money or incurring a liability for some benefit, services or property received is called expenditure. Purchase of goods, purchase of machinery, purchase of furniture are the example of expenditure. If the benefit of the expenditure is exhausted within a year, then that expenditure is expense. Otherwise, it is expenditure. It may be in the form of machinery, furniture, land, building, etc. Profit. Profit is the thing for what that business entity is running. So we must understand the profit. The excess of revenue of a period over its related expenses. As I told in the first lecture itself, revenue minus expenses, that is profit. So that is what here is here mentioned, that excess of revenue over the expenses during a specific period, that is accounting period, is called profit. Profit increases the investment of the owner. Gains. A profit that arises from events or transactions which are incidental to business, such as sale of fixed assets. See, sale is the different thing, profit is different thing. Profit comes from the sale of the goods or services. Gain comes from the incidental businesses. The entity is not basically for that purpose, but somehow since that entity is having some assets, so on that asset if some appreciation is there, that is known as gain. So basically gain is on immovable property. So a profit that arises from events or transactions which are incidental to business, such as sale of fixed assets, winning a court case, appreciation in the value of an asset. Suppose Big Bazaar is having some buildings. So after 5 years or 10 years or after next year, let's just take one example, one financial year. So next year, either the value of that building will come down. So if it comes down, it is depreciation, and if the value goes up, that is the called gain. Main job of the business Big Bazaar is not selling or purchasing of the building. Their main business is selling and purchasing of goods, but building is incidental to them. So whatever is happening, if the value is increasing, that is gain. If value is decreasing, that is depreciation, loss. Excess of expenses of a period over its related revenue is termed as loss. Loss is inverse to profit. In profit, revenues are more, expenses are less. So when revenues are more, expenses are less, so balance is profit. When revenue is less, expenses are more, so then there will be loss. Revenue means income. If income is 90 rupees and expenses are 100 rupees, so 10 rupees loss. If income is 150 rupees, expense is 100 rupees, 50 rupees is profit. So that we have to understand in this way. Discount. Discount is the deduction in the price of goods sold. Whatever goods are being sold, generally that businessman, that entrepreneur, he will give some discount to the wholesaler, or wholesaler will give some discount to retailer. Many times retailers also give some discount to the final customer. So if discount is given at the time of buying, that is called trade discount. If discount is given before the buying, that is called trade discount. That MRP is 100 rupees and I am selling you with 70 rupees. So 30 rupees is discount. But that discount is known as trade discount, because the person who is taking, the wholesaler or retailer who is taking, he is going to further sell it at a higher price. So that is why it is trade discount. Another discount is cash discount. Many times what happens, that amount is sold on the credit, and one condition is added that if the amount of the sale, if the money is received before 15, then 1% discount. It's basically, it's credit is the cash, getting the cash, immediate cash is encouraged by giving 1 or 2% discount. So in the sale agreement itself, it will be mentioned, if payment is done before 20, then 5% discount. If payment is done after 20, no discount. And if payment is done after 1 month or 2 months, then interest rate starts. So this is the discount. What discount? Cash discount. So one is trade discount, another is cash discount. Now voucher. The documentary evidence in support of transaction is known as voucher. Whatever transaction takes place, there has to be some documentary evidence. So whatever documentary evidence is available, that is known as voucher. For example, if we buy goods for cash, we get cash memo. We are buying some goods. So we are buying the goods, we are giving the money, and we are getting the receipt. That cash memo we are receiving. So that cash memo is voucher. If we buy on credit, we get an invoice. If we buy on cash, then it is cash memo. If we buy on credit, then it is invoice. When we make a payment, we get a receipt and so on. So these all are the vouchers. Vouchers are return of the money paid or payable. Then goods. It refers to the product in which the business entity is dealing. For what purpose that business entity is made. If business entity is selling TV, so that TV is good. If business entity is selling mobile, so that mobile comes under the goods. That is in terms of which it is buying and selling or producing and selling. The items that are purchased for use in business are not called goods. So if whatever items are purchased for the manufacturing process, they are not the goods. What is the good? Goods are the things which are sold, for which that unit is dealing. Many times one item may be good for one company and the same item may not be good for the another company. For example, a furniture dealer purchase of chairs and table is termed as goods. Furniture dealer is purchasing chair and table, so it is called goods. Why? Because he is purchasing for the selling purpose, so it's goods. While for others, furniture is treated as asset. If we are purchasing furniture for use, that is asset. If we are purchasing the almirah for use, that is our asset. If we are purchasing some house to use, that is the asset. If we are purchasing the house for reselling, that is goods. So we have to understand in this way. Drawings. Withdrawal of money or goods by the owner from the business entity for personal use is known as drawings. So whenever owner takes some money or some material from the business entity for his personal use, that is recorded in drawing heads. Then purchases. Purchases are total amount of goods purchased by a business on credit and or cash for use or sale. So whatever things are purchased for whether for use or for resale, that these all, whether on credit or on cash, these all are known as purchase of goods. Stock means inventory, stock of items. 10 furniture, 20 furniture, these all the stocks, these are the inventory. It's measure of something on hand goods, spares and other items in a business. Debtors are persons or entities. Debtor may be a single person also, debtor may be company also. So debtor, whether it is a single person or entity who owe to an enterprise an amount for buying goods and services on credit. So if someone is taking an amount, some goods on credit, so that means debtor. If some person is taking some amount, he is a debtor, and the person who is giving that amount is the creditor. So for debtor, the business entity has to pay him later on, and for the creditor, the business entity has to take the amount from him today or tomorrow. So these are the basic terminologies, these are the minimum terminologies. There are 1,000 terminologies being used in accountancy. These are the minimum terminology, we should learn it and revise it. They are not only important from the examination point of view, but they are important for understanding the next chapters also. So please keep on revising, keep on understanding, keep on watching, and if you like my channel, please like, subscribe, share and comment also. I always welcome comment, whether it is right or wrong. So please make a habit of putting some your comments in the comment section. Let us meet in the next chapter, and that chapter is bookkeeping and accountancy. Till then, namaskar.